Namaskar, I am Abhijit Roy, an investment banker. Today, I am in front of you to take you through the amazing journey of startups and how, as an individual investor, you can benefit out of it, you can grow with the startup, and also you can make good amount of money. However, in the investment banking world or in the investment world, making money is easier said than done. So when you are investing, you also need to be careful about where are you investing, what needs to be looked at, how do you ensure that as an individual or an individual investor, what are the things you need to look at, how you need to protect yourself as the company is growing or not, and how you ensure that the amount of money you have invested comes back to you multiplied by certain times. Sometimes the multiplication factor could be 2 times, 3 times, 4 times, even 10 times, even more also. But it's not so easy to achieve that until and unless you know what are the things to be looked at regularly from an investor protection side and continue the journey of making good money from your investment. So today I'm talking about the protection of investor interest related to investment in startups. So before I go into this, I think it's important that we talk about the status of the Indian economy and where it is today. As you know, Indian ecosystem is growing at a very fast pace. We have already reached a 8.5% growth in GDP. If you look at over the last 3 decades, it has been continuously growing. We are already a 3 trillion economy, and this growth is only possible when the drivers of growth from the government as also the private sector comes together, join in hand, and make this growth possible. Now, what are the different drivers of growth? If you see, one side, when we look at our economy, it has been a very large agrarian economy. We have been a growing nation over the years. And as we have grown, we have seen the public sector playing a massive role. But as we have grown to a level wherein we are recognized as one of the largest economies, we have to also think that along with public sector, the private sector has to grow very well. And with that intent, if you look at the entrepreneurship has being promoted strongly by the government, and the enabling ecosystem is being done in a very effort from the government and the industry together, which has seen that lot of new initiatives are being taken. To give a few examples today, if you look at all the engineering colleges have come up with what you call as the entrepreneurship cells. So earlier we used to think after you pass out, go to a college, go to a job, and then you think of entrepreneurship. But today I see that in the second year onwards, students are starting with different models of entrepreneurship. They want to be an entrepreneur when they are studying even. So things are changing. Today, I think the generation, the youth is actually becoming, a creator of lot of business opportunities and jobs at the college level itself. So that's how I think we are seeing a shift in the approach of entrepreneurship, which leads us to believe that the startup ecosystem will be growing in leaps and bounds. And government has been kind enough also to take a lot of initiatives. Like one of the big things to talk about is the different type of incubation cells which has been set up by government, different types of startup schemes wherein grants, loans, equity, and related support to help entrepreneurs, including mentoring support, to grow them. Not only this, if you look at the 10,000 crores of startup fund of funds which has been set up by Government of India, that is actually also helping lot of early stage venture funds to set up shops so that they can support lot of entrepreneurship in India. Now, it is so pleasing to know that out of this almost 10,000 crore, I believe about 8,000 plus crores have already been committed, which itself is a big number. And that has actually resulted in a lot of flow of funds to the startup sector. Now, the the way we are seeing unicorns in India, as you probably know, India has the highest number of unicorns, across the globe. And these are unicorns which has been made in the last few years. It's not that we have been running this journey for long. It's only in the last few years we have seen so many unicorns that has come up. Obviously, many of them are tech-led, but there will be a lot of them which are not even as much of tech-led as it looks today. There could be services, like if you look at, institutions like, Zomato, institutions like, Swiggy, the amount of employment it's creating is massive. So the faster they are growing, the more employment that is being created actually, is encouraging a lot of, professionals to come into the startup ecosystem. And that is pretty clear that, it's going to grow only. Now, in view of that, what has happened is earlier, if you look at only venture capital funds used to invest. Now, it has become a sort of norm to do a angel round. What I mean by angel round is very early stage capital raise, wherein individuals participate. They are called angels. So they come in. So which means that you and I today can become angel investors by putting in as small a token amount of say 1 lakh, 2 lakh to 5 lakh to 10 lakh. And you will be happy to note that many of these investments are generating return of 5x to 10x is in 1 year's time, because the market in India is massive, because investors are trying to back different type of entities today, and also the fact that India is a very large economy. And if you look at it, for the investors also, the global investors, it offers so much of opportunity, because today, from a perspective of investment, China is restrictive. From a perspective of investment, the entire CIS, Ukraine, Russia going through war, investment opportunities are limited. If you look at the LATAM countries, Argentina or Brazil, they are fighting their own war in terms of their growth and other things. Not really a war, but I'm saying the challenges of growth, and the economy are in shambles. So where will the investor money go? So India is a very large market from that perspective, and we have picked up the growth rate pretty well. So keeping in view that, we are seeing tremendous amount of interest from individuals to come and invest very early. And the main focus of this program is to talk about what are the things you need to know before you invest, and how to protect yourself so that your investment remains sound, the investment grows and makes very healthy return for you. So now, first question comes, who backs you in the early days as an entrepreneur? We call 3 Fs, friends, family, and fools. And sorry to use the word fools, but why we say fools is because people who trust you in the beginning, because you are not yet started the business, or you are about to just start the business, or you have just started the business has not yet been established. So people who can back you are generally called that, friends or families who know you, and the fools who trust you. And here the fools are the angel investors. But effectively, if you look at it, they are the ones who make most of the money, right? Because they back the right entrepreneur at the beginning itself. So we'll go now deeper in terms of talking about what are the type of instruments through which the angels, investors or the individuals like you can invest today. Simply, there are not too many options. Actually, options are very limited. But then within the option, there are multiple other differentiators which come up. The two simple options, what we see today, are either equity or debt. When you talk of equity and debt, what are the difference? The major difference is equity is much more risk-taking ability of the investor. Debt is less risk ability, right? Second is debt has a fixed return. Equity return could be very high, very low, right? You are never sure of when you will get your money back. You are never sure of what time the money is going to come back. You are never sure that whether you will recover your principal or you will make a 10x. So it all depends on how the startup is functioning, right? So there is no fixed timeline. There is no obligation of payment from the company side. There is a huge risk associated, and obviously there are rewards. On the debt side, you are not taking huge risk. That's why rewards are limited. Rewards in the form of interest, and it is a different timeline, definitive timeline, which could be a year, 6 months, or 2 years, or 3 years, right? Depending on the requirement of the business. If I look into the equity, there are two basically instruments which are being used by whether it is a company or the investor who is investing the money. The most common, and we know in India, is called common stocks or ordinary shares. These are the simplest form, wherein like any public company you invest in, you basically buy their common stocks, right, in a listed entity. Here also in a private company, you can buy a common stock. Now, common stocks are not so preferred by investors, and there is a reason for that. I'll come to that in a bit. Now, what happens is, as a common shareholder, you have voting rights. You can get your dividends if you want. If the company declares dividend, you will get your dividend, and you have the rights on the assets of the company. That's the normal definition. Now, coming to preferred stocks, this has always slightly different because it has a word preferred than the common stock. That means in case a company goes into liquidation, God forbid, it should not happen wherever you're investing, but you never know. Circumstance may happen that a company goes into liquidation or it winds down. You have a better right than a common stockholder on the assets of the company. That means in a liquidation system, the debt comes first, the debt lenders or the debt investors get their money first, then comes the preferred stockholders, they get their money, and whatever is left after that can be recovered by the common stockholders. So that's why most of the investment done in the startup, people prefer to do it through a preferred stock. And preferred stock can also be looked at from two different perspectives. One is that it could be a compulsory convertible, means that it has no choice but to be converted into equity after a certain period of time. But the company or the investor has an option not to convert it into equity and get the payment later on through an option of buyback or a redemption, right? So that's why it has an option. But compulsory means it is necessarily converted into a common stock after some time. Whereas optionally convertible can be returned back or can be converted based on the requirement of both parties. Now, coming to the most crucial part of this discussion. So we understood how we can invest either through a common stock or a preferred stock, or if it is a preferred stock, it could be a compulsory convertible preferred stocks or it is an optional convertible. But now comes the question of that if I become a partial owner of the company, how do I control the things what is happening in the company so that I know that my money is safe? When I say safe means it is really being utilized properly. It is being utilized for the purposes for which it is needed to grow the company, and it is able to help me or the company to generate returns for the investors, right? So if we look at from that perspective, we'll have to think how do we be a part of this process and ensure that we have certain control functions, right? As an investor, as an individual investor. Now you can have it through a board controlled option. When I say a board controlled option, what I mean by that is whether you can be in the board of a company. Now once you're in the board of the company, then you are part of all the deliberation that happens in the board. What are the documents being put up in the board, including information about how the company is doing, where they're spending money, are they really making losses? If the losses are there, how much is the loss? What are the type of gross profit margins they have? What is the EBITDA level? Are they growing but at efficiently over the last few months? So you have access to all the information and you can participate in the discussion and deliberation of the company to give inputs about what needs to be done, what should not be done, right? What you think out of your own experience. Now, there is a catch here. If you are a minority investor, if you are a small investor, let us say you hold only 2% of the company, maybe you will not get a board seat. Then you'll have to think collectively between 4 or 5 investors coming together, can you have a board seat? And then one of 5 or 6 together who hold say 5 or 10% or 15% can be representative in the board and take those calls or discuss all this or convey the view of all the investors together, right? So this is very important to understand why you need to have a board position if possible. However, there are other options which I'll come in a bit later. Now, even if you don't get a board position, still you can know what is happening in the company by participating in the board meeting. So say the threshold for being a board member is 5%, but you only have 4%. So you will not get a board seat. What do you do there? Then you negotiate with the founders or the promoters saying that can I get an observer seat? Now, observer as such has no rights, but he is part of the deliberations. He can take notes, he can share his views beforehand and say these are the questions if you can address. He will know exactly what is the discussions happening in the board. So he or she will have really good access to what's happening and would know the company is going in the right direction or not, and if there are any inputs required to be given to the board or to the management so that the company is steered well and your investment remains protected and growing as well. So this is the way to go through a board approach. However, it's not always possible to have everything through board. As I said, it could be the percentage shareholding that you don't have to get into a board position, which is called a threshold shareholding, or even the company doesn't agree to give you an observer seat. Then how do you know about things? Now then you get into a shareholder agreement details to understand what are the different things you can get as an investor to know about the health of the company. So it could be your information rights. What I mean by information rights? That every month the MIS, which is the Management Information System, is being sent to you. MIS data is sent to you on a monthly basis, on a quarterly basis. And in quarterly, there is P&L, means profit and loss account and balance sheet, which is being sent to you so that you exactly know how the company is growing. You exactly know that what's happening in the institution. Are the gross profit margins increasing? Is the EBITDA looks healthy? Is the company in a path to profitability? Is there enough cash in the business, which is very important because the company has to grow if needs enough cash, or it is raising equity or debt. All those things are very clear, even to the extent if it's taken debt, whether it is heavily leveraged or not. So through the MIS, you can understand about the company and if need be, connect with the promoters or to the other shareholders together, and you can write to the company to say, hey, these are the things which worries us. Can you look into this? Can you tell me what are you doing? So that you are continuously giving inputs and trying to protect your investment, right? So that is very important to understand what happens in the shareholder agreement. What are the things through which you know what are the obligations and rights of the promoter, what they need to share as a company with you regularly, whether there can be investor calls specifically which can be done on a quarter to update the investor about what is happening in the company, what are the corrective steps being taken if there are any challenges that the company is going through, and things like that. So it's very, very important to understand that. And then, there are other things like, which you can do either through a board position or through shareholder. Like say when you invest in a company, you betted on the two promoters, let us say A and B. The promoters are there, but all of a sudden it happens that A and B, A, who is the most, charismatic person who has been growing this company, decides to leave, or something happens, he will no longer continue. But you bet on that person, right? So he cannot just go away like that. It needs to be brought to the notice of the shareholders, taken their approval, and then only he can go, and we know who is the replacement. Is he competent enough? So the shareholders should know. So you either through a board, if you have a board rights, or through a shareholder, can control these things in the sense that you have been informed why he is leaving, what is the reason, is there a replacement available, and can we quickly get a right person who can lead this, and you are comfortable with that. Second is, let us say, change of business. You decided to fund a company for a business which is into, let us say, electric vehicles. And that has a huge potential because there are a lot of government subsidies, there are a lot of push by the government, there is a market which is accepting that. But all of a sudden they decided they will not do electric, but they will do fossil fuel driven vehicles. Again, that's not what you invested for. That was not your focus. Now, if they are changing, why they are changing? What is the reason? Is they not able to run this? Is there not enough demand? Why they are changing it? Then is there a way you can protect and say, hey, give me an exit before you change the business? Third could be like geographical expansion. Let us say, to give an example, the business you invested is about ice pops, and you are in southern India where hardly there is any winter. Let us say in Chennai. The business is in Chennai and Hyderabad, and it's about ice pops. And that will sell in summer and winter equally well. But assuming you want to expand in Shimla, whether it will sell? So the company may think differently. They say that no, softies sell in Shimla, so ice pops will also sell. But that may not be the case. So I think that's where you have to, as a shareholder, put your foot down or even ask the right question and say, you have to take my permission before you do that. Now, next point is, say you want to bring in new investor in the company. I mean, new means the promoters. In that case, what happens? The investor may be from real estate, which you are not comfortable with, right? It may be from some other sectors. So why you want to bring them? So you should have a say in that, right? Coming to change of auditors, you have supported the company because they were having a very good auditor. If the company is changing the auditor, what could be the reason? Is it that they are not comfortable with the auditor? Is it that the auditors are trying to disclose something which the management is not comfortable? That means, is there a problem in the company? So there may be some signs you will get when you ask this question. So these are the important points you need to know. Similarly, like when you get capital investments, right? Whether you need to get the equity or debt. Now, what is required at the point of the company? Equity is better or debt? See, if you bring in more equity, if the founders bring in more equity from investors, you as a shareholder gets diluted. But maybe they don't need so much of equity right now. Maybe they can do with a combination of debt and equity together. So all these things are very, very important to understand, and you should have a right as a shareholder to get these things vetted by you and give the right input so that you can protect your investment. How to get an exit? And it is very important that you understand what an exit is and try to negotiate that. So I'll quickly run through this. The most common is secondary exit. Means as the company grows, it brings in new investor. So the early investor is exited by the second, third or fourth round. That's called secondary exit. So one investor is selling to the other in the next capital raise. The most common, people will say IPO, but it's not easy to do IPO. But IPO is also one of the common way to to exit. And the last but not the least is the strategic sell, which is we've seen a lot. And strategic sell is not from a larger competitors alone. It could also happen that some large entity sees you as a threat. That means, say you are building chips and there is a big entity which also makes chips, but your chips are becoming low cost and very efficient. Now, either they take it and run that business, or they want to kill the competition because their brand is getting impacted. So they will buy it and kill it inside. So there are two different ways of looking at strategic, right? So it depends on what approach the buyer takes. Okay, through that also you can get an exit. There's also another option wherein, especially for early stage investor, you need to figure out a way to exit through a buyback. Not a very common part, but buyback can be done. Regulations are very strict in that you can't do more than 25% in a year. It has to be only done through reserves and surplus. And if the company doesn't have enough reserves and surplus, it's very difficult to do a buyback. But obviously promoters, if they're rich, they can do a buyback. So always try to, as an individual investor, try to see if there's a way you can do a buyback. And you can also have a minimum contracted IRR if you want. That's also very important as an early stage because you're taking huge risk. You should have a minimum defined IRR. If possible, negotiate that. Coming to the last part is that whatever way you do, it's more important that you understand that this is a risky bet. Any investment you take or you make on any startup is a risky bet. And you should think all possible ways to see how you can protect yourself from the company not going in different direction which you didn't want to invest in the first place itself, for which it was being set up, then it is going in a different direction. 2, you have to always ensure that your rights are protected. Means you can look at the company's growth, you can take a call on what's happening right or wrong, and you have a say in that. So that can be through the shareholder agreement, as I said. It could be also through board rights. Both are important. Third is, and the last and most important part is, you should always think of how do you structure your exit. Be very, very clear. Don't keep it very open. I know it's not easy to exit a startup, but you should try to have as much of protection. And one thing I want to highlight here, which is very important for you as a minority shareholder, that please ensure that any other larger shareholder exiting the business, or even the promoter exiting the business, you should have a right to tag. What I mean by that is, you should tag along with that investor or the promoter if they're exiting a business. The promoter cannot exit till you are there. So it's very clear from that perspective, right? So I think these are the few things I wanted to share. Very happy to help you whenever you want. Having raised, more than 25,000 crores of equity and debt over the years, we are always there to help. And as an investment banker, I always think that we should give as much information for a shareholder to know what they need to know before they put in money. Thank you, Namaskar, and Jai Hind.